Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The market since mid-January has run along down the underside of the purple highlighted upper time, currently at 2034, of the early November 2023 to mid-January 2024 bearish shift pitchfork for a large part of its time. In late February for a few days and then again in late March until early April, there had been a strong drive higher over the upper time, but the move up failed. The first time was at the overhead congestion between 2390.90 and 2408, and the second time by the combination of the congestion in the 2235 area, the declining short medium moving average currently at 2165, and the influence of the declining medium moving average currently at 2201. Prices 3 weeks ago started pushing down through the familiar stratified congestion zones between 2140 to 2148, 21 even to 2107, 2069 to 2076, 2047 and 2003. This general zone between 21 even to 2010 also features as a congestion area back between January and February 2017. Now, by Thursday 3 weeks ago, prices had pushed back on down within the purple highlighted bearish shift pitchfork, and then down through the April 2020 to date uptrend, currently at 21 even. And the next uptrend, the pink highlighted April 2021 to date uptrend, currently at 2017. All the way down to just short of the bright green August 2022 to date uptrend, currently at 1881, some way below where the market staged a small turnaround 2 weeks ago. However, the turnaround was, to put it mildly, modest, with the market being capped by the broken pink uptrend and the March 2023 low. And there is where we've stayed, in between the broken pink uptrend overhead and the unbroken light green uptrend below. In all this, it looks like the bearish purple shift pitchfork might have started to reassert itself. But I'll give a few more sessions to verify it. In the meantime, we have the conditions set with only a few days left for April to be a possible monthly key reversal. Thus, if we close on the 30th of March, so that's tomorrow, either over 2258 or 2252, it's actually a somewhat surprisingly narrow range. Well, then we'd be on. Anything in between and we would have the lesser outside month pattern. Right now we are very much looking at a monthly key reversal down. There are two final patterns that I would like to discuss. The first is the late February to date bear channel, highlighted in dark blue on my daily chart, currently at 1880 to 2187. It is still somewhat nascent, but it deals with the price action outside and above the purple highlighted bearish shift pitchfork rather well. I'll see how this idea develops, but as I say, right now it looks good. Then there's the action of the last 2 weeks, and I'm wondering if this is becoming a bearish halfway hesitation or a bottoming action of some form. Now, right now, I'd edge towards the bearish halfway hesitation, but it's still very early on in this idea. Ice Europe, white sugar in London. The market from the middle to end of January had been wading through stratified levels of support and turning into resistance above, such that prices had dropped down to below the interesting 625.30 to 602.70 congestion area, and even dipped down below the breach, but at the time unbroken support of the purple coloured uptrend, currently at 611 even, and that's dating from October 2022. There was some further congestion below between 590 to 592.80, which finally held up prices in early March, before we saw a move back up 7 weeks ago. Then 5 weeks ago, we had a break higher with a daily key reversal up, followed by a 2-day descending hawk pattern traditionally seen as bullish. And prices punched up and closed over the short medium moving average, currently at 617.5, using it as a proxy for support for a further attempt higher during late March and very early April, filling in the mid-February changeover gap. For a while, it looked like the strongly declining medium moving average was giving way, and we did see it being pierced as recently as 4 weeks ago. But There were never two consecutive closes over it, and the medium moving average acted as a strong cap, held by the 50% Fibonacci line of the January to September 2023 move at 652.20, and prices turned around and headed lower. Below and along the short medium moving average, that's where we moved until at the start of 2 weeks ago, when the market created a quite good looking and strong key reversal down just prior to the quite large changeover gap lower, quite large. This new gap had prices down below the recent stratified supports and into open territory that just had the February 2017 high nearby at 565 even, and then really nothing until the March 2017 high at 548.70. Well, the market realized what this looked like on a continuous daily chart such as mine, and has seemingly stabilized, though not really managed to even start filling in the gap from 613.40 down to 580.30. Now, there is always a tendency for markets to fill in gaps, including changeover gaps such as this, though I would not suggest holding your breath for this one to happen. This brings me to a point I raised 2 weeks ago, and I quote, "Over the last few weeks, I've been voicing a question here that I've been posing to myself. It is this: is the action since early December last year, is it developing into a double bottom or some sort of wedge or triangle pattern? Last week, it was still too early to tell, but I am more confident now that the late December 2023 today action is perhaps a possible descending triangle. Now, I've outlined the triangle on my daily chart in bright red, currently at 593.80 to 656.10. This is a pattern to watch, just in case it morphs into something else," end of quote. Now, today I'm still unsure about this pattern that I had previously been sort of putting forward, purely because I do not like the changeover gap causing the market to drop below and out of the pattern. Doesn't mean that it will not work, it's just that, well, I'd rather it move down during the course of normal trading rather than this. However, now that we are here, it would seem appropriate to set out some potentials below for the possible and somewhat short-lived descending triangle pattern. Thus, a primary target X for such a pattern, it would be down in the 544.80 zone, 80, whilst a harder secondary target X1 will be down at 497.60 in the 497.60 zone, which is way off the bottom of my daily chart. I am unsure about this one, and I will watch it with great caution, both X and X1. I would only now add the small postscript that the action over the last 2 weeks or so has grown to become possibly either a bearish halfway hesitation or a bottoming action of some form. Here, likewise, it is too early to tell which it may be, if any, though I have a natural disposition to look at it as a possible bearish halfway hesitation. But I could easily be so wrong on that. Sugar white premium spread. It must be close to, if not over a year here, that this chart finds many things are still going on all at the same time. Okay, so I've previously spoken some while ago now about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart. The lower time below, currently at 135.5, tested but not broken, even over the last 2 weeks. We also have down here many of the moving averages between 130.75 to 140.5. Now above, we have the congestion between 162.75 to 164.75 that had until recently the rising neckline extension of the June 2021 to May 2022 reverse head and shoulders bottom, currently at 165 within it, plus the 2012 high at 164.75. There's also a further congestion above between 173.75 to 175. Now after this, we have a pretty clear area topside over the congestion at 178.5, all the way up to the dark blue middle time, currently at 209.75 of the same bullish Andrews pitchfork. 2 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to the London Sugar Month changeovers, but it nevertheless still effectively countered the previous week's bullish closing white Mariposa. Back then, I also considered topside targets for the big elephant in the room, the big February 2022 to August 2023 diamond top pattern highlighted in dark green on my daily chart. That's a primary target. X, which isn't that easy to reach, would be in the 250. That's right, 250 area, with a secondary harder to reach target X1, a much harder to reach target up in the 291 area. I added, and I quote, "I can see my finessing these at some point as they are currently both off the top of my daily chart, my weekly chart." End of quote. Well, last week we've had enough of the dreaming and we'll stick to the cold, hard, immediate reality and consider the dark blue lower time along with the nearby moving averages as the key element in this market, and no more than that for now.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.